Welcome back to the Bitcoin Layer. Today, Nick and I sat down to discuss the FOMC meeting and the cross-asset implications for the decision to hike by another 75 basis points and what the path for monetary policy looks moving into Q4 and beyond. Take a listen.
I want to set this up for you guys with 14 minutes to go to this decision. What is the split in the market? Let's start with what isn't the split. We know that core inflation is as high as it's been in decades, and it isn't showing any material slowdown. That's what we know. We also know that the Fed, as recently as August, in Jerome Powell's Jackson Hole speech, used the word forceful to describe the way that the Fed is going to deal with that inflation. So we have high inflation and the forceful rhetoric from the Fed. That is why the Fed will be raising rates by 75 basis points today. They've telegraphed that to the market. They have over communicated it, and the market is right at 76 basis points today in terms of its expectation. So that's what we know. What we don't know is how the Fed is going to treat the future. So on the extreme side of the hawkishness, and hawkish means fighting inflation. On the hawkish side of things, the Fed could possibly today change absolutely nothing in its language, deliver the same statement as it did last time, which is we're hiking 75. We are going after this hot inflation. We are going to make sure that we don't let up easy. And we see the labor market as being very strong. And the US economy is not in recession or entering one or flirting with one. That would be the super hawkish side. The super dovish side would say, we're raising 75 today, but we're starting to see the economy slow down a lot. And we'll probably be raising rates once more in December, and then we're done. That would probably be the most dovish that the Fed could get today. So what's going to happen? Probably something in the middle, where that language will change a little bit. They'll say something like, we're starting to see certain sectors of the economy slow, like housing, for example. We're starting to see businesses receive slower rate of new orders. And therefore, we're starting the discussion of what is the best end of this path and how we're going to get there. So that's really what we're expecting here. Now, what the market is looking for is what the language that they use. What's the language that they use? And that's when, part of the zoomed in part of this job, it does feel a little frustrating sometimes because we have to parse through every word of the Federal Reserve to, dictate how we're going to invest and allocate and all that kind of stuff. It does get a little bit tiring, I will admit. But that is the nature of the markets as they trade today. We see Bitcoin's correlation with the stock market's correlation with yields, the yields correlation with the dollar. Right now, all markets are functioning as one trade, and it is largely led by what the Fed is going to do. So let me pass it to Joe. Joe, what's on your mind and what will you be watching today?
Absolutely. Thanks, Nick. So to kick things off, and by the way, I'm speaking from the Bitcoin Layer Twitter account. Just to kick things off here, I share sentiment with a lot of what you're saying. At this point, we've seen so many false tops in Fed funds expectations this year We almost sound like a broken record by saying this is going to be the time, this is going to be the time. But really now we're starting to see marginal shifts, not only in Fed speak, but also in the condition of the global macroeconomy that could eventually force more dovish speak from the Fed. And that is why the what's being watched by myself more closely than anything is literally just the rhetoric of Fed officials. What are they saying? We know that 75 basis points is basically ossified for this meeting. We know that 50 basis points is basically ossified for December. What we want to watch for is how the Fed language portends the future path for monetary policy. That's what matters for markets right now. That's how markets are going to trade. That's how markets are hedged right now. And so basically moving ahead into the meeting, I've got my terminal up here. Again, as I just said, expectations are firmly set for 75, right? That's essentially set in stone. It won't be much of a surprise. The real thing to look out for is going to be that rhetoric from Jerome Powell, when he comes out and gives his speech. While we'll still be on here, I'll be able to give live updates of the word choice that he's using. In the last few weeks, we've seen a bit of a conflict between the way that speakers are talking. We're seeing a difference, even if it's a marginal difference, between Fed speakers. Chair Daley is coming out and openly talking about the risks of over tightening, and then other chair people are coming out and say, basically doing the exact 180 of that and saying that we're nowhere near that. Inflation remains the number one hot button issue. We don't see financial turmoil. At the same time, you have Janet Yellen coming out and conflicting what Mary Daly is saying as well, and saying that the Treasury market illiquidity might be cause for concern, and they were weighing a buyback. Obviously, as of today, Nick, you and I spoke about this. There will be no Treasury buyback facility from the Treasury, but that's just as of right now. The fact that these conversations are occurring in the first place are very telling. And so that is essentially what I'm looking for. Jerome Powell is in disagreement with Janet Yellen, who is in disagreement with Mary Daly, who, all of this under the umbrella of Nick Timmerhouse from the Wall Street Journal, giving this new forward guidance mechanism of essentially telling the markets what the Fed's going to do beforehand, so the market can better position itself and it's not as surprised. Because as we know, everybody in this call, markets hate not having their expectations met. They hate uncertainty, right? Even if in the case of, let's take job openings yesterday for an example. Obviously more job openings is good for the economy, but markets traded down. Why? Because more job openings means potentially hotter inflation. Because obviously wage price inflation is a component of that. The consumer remains strong, right? So therefore more hawkish Fed, so therefore risk trades down, right? So ultimately you got to think what the markets are expecting. And in this case, markets are extremely ambivalent on the path forward beyond November. November is 75. We've been getting this conflicting speak from Fed speakers, from outside analysts, from the Treasury Secretary. And so really it's just a matter of taking a look at Fed speak and seeing if there's any clarity that gets provided there. So that's what I'll be taking a look at. I'll be taking a look at the headlines as they come across my screen.
All right, let's strike everything. And strike we use to describe where are all the levels going into the meeting, and maybe what are some of the levels that we're watching here. So I'm going to start with the U.S. Treasury 2-year yield, trading right now at about 4.5%. Now, one thing that we've talked about is if they are on the hawkish side of things, that means policy rates are probably heading to 5%. Right now, they're going to hit 4% today. They're going to hit 4.5% at least in December. So if they're even more hawkish, that means policy rates are going to 5. So with 2-year yields at 4.5, they could go straight to 5 in a few days if the Fed is very hawkish today. So that's one of the things we'll be watching. I think 4.5 is about the fair rate on 2s because that's where the market is pricing the policy rate to end up, or to be over the course of the next couple years. So 4.5% on 2s, that's where we are, 453 to be exact. The 10-year yield is trading at 4%, 4.03 to be exact. 10s tested 433. in later October. 433. So we are trading lower on the 10-year yield relative to a couple weeks ago. And it is the Bitcoin layer's base case that that level will be consolidated. That's cheap enough for 10-year yields for demand to emerge. And the demand can come from anywhere. It can come from banks that are okay with buying now because they see the hiking cycle almost over. It can be from the investment universe because they see growth slowing across the world. It can come from foreign governments as they look to shore up their risk position heading into a growth slowdown. And it can come from hedge funds that are trying to do a leverage trade and are trying to pick the bottom. So any one of those can be the source of demand. We know what the source of supply is, and that's investors scared of inflation and unwilling to hold these notes and bonds. So that's the tug of war. But we think that 4% is a very fair value on 10s. So we'll be watching 4% on 10s, 4.5% on 2s. Let's look at SPOOs. That's the S&P 500. We're in this 38 handle. Just zooming out a little bit to give context. The all-time high on the S&P was about 4,800. The low from June that we thought would serve as the area that risk allocators finally come in was about 3,600. We did trade down to 3,500 a couple weeks ago, but recovered and are at about 3,800. Now on my chart, I see this range, the support being around 3,600 and the resistance being a declining trend line that connects these three highs from January at 4,800, March at 4,600, and August at 4,300. So we have a lot of pressure at about that 4,000 area on the S&P 500. So that's kind of the zoomed out look at S&P. And then, of course, Bitcoin 20,000 now that we've kind of recaptured some of this momentum. I wouldn't call it momentum. We've recaptured some of this buying source in Bitcoin. We will be watching this 20,000 level. Does it hold here? We obviously think that the lows have been in for the year. Bitcoin has traded really well in the 18,000 area. Let's see if it can really hold this 20,000 area. But that's what I will be watching here with 2 minutes to go to the Fed. I want to answer your questions, guys. So let's get into some questions at around 11:15 Pacific time. That'll be about 15 minutes after the market starts to digest what is coming across the tape. Some of the other levels that we can watch are par in the dollar versus the euro. So it's at about 99 cents right now on that pair. We'll be watching that level to see if the dollar is reacting strongly to this. And I personally have been watching boons, which are, closing for the day. The German yields, we'll have to see. They will definitely tick with how treasuries tick today. So decision coming up here in just under a minute. Joe, any last thoughts? And then you can read us some of the headlines going in.
Of course, yeah. I'll get some headlines read. I'll get the decision factored in. For those just tuning in, why on earth is a company named the Bitcoin Layer talking so specifically about interest rates? Well, I'll throw the question back at you. Why do basketball players go to the weight room and lift weights? It's because, basketball isn't the only component that factors into playing a game. It's also strength training. It's also all these other things. So and as expected, 75 basis points is the decision for the hike. I'll take a look at some of the rates news as they come in real time. It will flash across the screen. I have several right in front of me now. But essentially, the reason we're talking about this so much is because macro runs the show. Rates run the show, especially now. We're in a very, very steep liquidity downturn. And so it's very important for us as we monitor, Bitcoin's monetization to and beyond wherever it ends up going, we have a very, very strict macro focus. So we're a global macro research publication that is tracking Bitcoin on its way to monetizing. Here's some of the headlines coming across my screen right now. The Fed needs ongoing hikes until rates are sufficiently restrictive. The Fed says it will take cumulative tightening and lags into account. So again, we're seeing similar words that we were seeing during other Fed meetings. Will sufficiently restrictive. That is an example. It will take cumulative tightening. And lags into account, which is funny because historically the Federal Reserve does not take lagging impacts into account. If it did, chances are it would have begun tightening as soon as it started to see inflation tick above, materially tick above where it normally is, right? The
And
Fed is just, yeah.
Joe, let me hop in here on cumulative tightening. This is pretty much the language that everyone's been waiting for. That was the phrase. Okay? So what you should see now is the market say, okay, the hiking cycle is ending soon. Where does it end? And and the rates market is now going to put the pressure on the Fed. So this is the big headline here. The Federal Reserve says it will take cumulative tightening and lags into account. That means it has hiked a lot. What they're saying is we've hiked a lot, and we think that we should wait and see how all of that plays out because we know it plays out with a lag. So this is dovish at the margin. This is dovish language that we haven't really heard them say. Cumulative tightening means we've gone 4% already. We've gone 4% already. We've done 3% in 4 meetings. So it's not, recession is coming. We got to stop now, right? Well, that's not what we were expecting. We're expecting some wordage here to suggest that they know they've done enough. They know they've done enough. The real estate market, look at prices on real estate. They've been plummeting. They're down on a nationwide basis for a few months in a row. And that's not really characteristic of the US housing market. And so, the pressure is on the economy due to tight policy. So this cumulative tightening is a huge, huge deal. And it does suggest that the Fed is well aware of what it has done. And what has it done? What has it done? It has tightened a hell of a lot into a bunch of weakness. So let's take a quick look at the market. To be very honest with you, these are muted reactions. These are pretty muted reactions. Okay, yields are down slightly, right? Twos were above 3, about 3 basis points above 4.5. Now they're about 3 below. Tens were just a little bit above 4. Now they're 3.99. Stocks are up just a little bit. Bitcoin up just a little bit. Although the Bitcoin, 5-minute candle, if you want to look at it, was about $600 in magnitude, which is average, right? I mean, we always see that. Bitcoin trading a lot and people getting stopped out of certain positions. The euro is rising, the dollar is weakening, yields are down a little bit, right? So the marginal trade right here, and we'll see the investor follow through. We'll see what Powell says in 26 minutes as he starts talking. But what is the big takeaway? The cumulative tightening language, it means we've done a lot and we'll wait and see. The lag word, like Joe said, the lag word is not something that we've really seen them acknowledge. They've been really focused on inflation. So, Joe, what other headlines are you seeing? And then we'll get you guys up here for questions. So, maybe start raising your hands in about 5 minutes as we digest a little bit more of the headlines. Yields are moving a little bit lower. Okay. The market is processing what do they mean, right? What do they mean? Well, they mean that they've done a lot and they're about to stop. Okay. When will they stop and how much will they do before they stop? The market will figure that out over the coming weeks. And maybe Powell will give us something even more than that when he starts talking later today. But you can be sure that the Fed speakers, once they start coming out and hitting the tape, they're going to have lots to say on how much we have left. What were they looking at to say that, okay, there's a lot of cumulative tightening that's occurred? Well, no shit, there's been a lot of cumulative tightening. The Fed loves to just state the obvious sometimes and wait months to acknowledge it. So yeah, yields about 5 basis points lower than 4.5 on twos, about 2 to 3 on tens. Bitcoin showing a little bit of life here, but again, the reactions are pretty muted. This is not any real volatility here. I think just a little bit of positioning. Joe, headlines. What are you seeing?
Absolutely. So just to read off a quick quote here, in determining the pace of future increases in the target range, the committee will continue to take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. And that was a sentiment shared unanimously among Fed speakers. That's the thing that's noted here in front of me. So exactly like you said, again, this is essentially what the market was expecting. At the end of the day, I tweeted out before this the twos Fed funds curve to the 2-year yield on the U.S. Treasury note. Historically represents forward Fed funds expectations. And we've seen these false tops in policy rate expectations all year, but going into this meeting, there was an expectation. The Mary Dailies of the world and the Nick Timmerhouses of the world, there was an expectation that there would be a slowing in the pace of rate hikes. And as of right now, though we're not getting that explicitly, you're starting to see the shift in the language from Fed speakers, right? They are hinting at slowing hikes. And, this could be perceived as grasping at straws. But at the end of the day, the market is unbelievably tight right now. Who isn't grasping at straws? There was a countdown clock yesterday to the FOMC meeting. In any sane world, apart from rates traders, this wouldn't be a meeting that is regularly watched by the entire markets community. But there's a colloquial understanding, ubiquitous is the right word, that the Fed is in the driver's seat right now. The Fed, the entity that sets the price of money, is fully in the driver's seat. And so moving into this meeting, everyone was on high alert for these extremely marginal shifts. What words have they not used before? I remember back in August, we were looking at words that they haven't used before, and the first time that they used the word forceful was in August. And in reaction to that, markets didn't like the word forceful, and so they traded off of that. And in this instance, there is a marginal dovish pivot you see with the words cumulative tightening, and the first time that they are using quite a substantial word in my book, which is the word lag.
Right. And we have to just give you guys a little bit of inside baseball on how this thing works. What do the algos are the ones that are trading this market in the instant, right? Humans will take a few minutes to read and think about what to do, but the computers that people have programmed will trade the instant that it comes out. So how does that process work? Well, we go to what we call a red line, which is you compare the last statement to this statement, and the computer program spits out the difference. And that difference, the new language is parsed and traded, meaning that there's an AI in there that determines whether it's dovish or hawkish, and it's traded. And so that's really how it works in the industry. So there are algorithms that have AI that do a red line of the Fed statement and trade it at the instant before humans can process. Like it took us 60 to 90 seconds to actually think about what this means, and for me to understand that cumulative tightening and the word lag means dovish, right? But the computer can do that in basically at the speed of light. And so that's how it works. And so that's what we're doing now. And so that's what Joe just read to you. He read to you the red line. So what does that mean? That means that that one sentence that Joe read to you was what the Fed spent the last 48 hours trying to come up with together. They sat in a room and they said, what is the one sentence that we should say to suggest that the hiking cycle is just about to end? And that we're no longer, that inflation is no longer the only thing that we care about. It's still the number one thing, but it's less than 100% now. And so let's say a sentence, and what's it going to be? So that's what they came up with. They came up with, and it's important to repeat it because this is the dovish pivot. It doesn't mean that they won't even hike in December. They probably will, and that's, we'll hear what Powell says, and I'll read a little bit of the headlines more in terms of what they're saying. But that in order to attain a stance of monetary policy that is sufficiently restrictive to return to 2% inflation over time. So that's part of what they're doing. That's part of what they're changing, is that sufficiently restrictive. That's the language. And then the other language that they say is they'll take into account the cumulative tightening of monetary policy and the lag with which it affects the economy and financial components. So stocks are trading well. Again, I mean, nothing really that dramatic. Yields are lower, nothing that dramatic. Bitcoin higher, nothing that dramatic. So let's get it going for some questions. I'd love to have people start raising their hands, and we just want to go into, what are you guys interested? What do you guys want to know about what's happening today? What will happen with the Fed? Maybe you have thoughts on, or you have questions about our outlook. So we want to open it up.
Most definitely. Let's start getting people up here. A few more interesting developments as we're sitting and waiting. Fed funds futures is implied by overnight index swaps. Overnight index swaps can be thought of as a derivative to the federal funds rate. Have now moved below 5% as a terminal rate. These have been choppy over the last couple of weeks, so that's not necessarily material. The more material development in my mind is that the December implied hike is now closer to 50 basis points. Over the last few weeks, it has been 100% ambivalent at 62 and 63 basis points, straddling that line dead center between 50 and 75. And, as we are talking right now, the way that we've perceived it seems to be the way that the market is perceiving it as well, that this linguistic shift is hinting at a slowing pace of hikes moving forward. So that is how the market is digesting it over in OIS.
Yeah, and if the base case then becomes here, the Fed is going 50 basis points more in December, and that'll pretty much be it. And that the economy is slowing enough for the Fed to, introduce they can't pause right away. They have to introduce a sentence that sets it up so that they can do it next time. I think that pretty much starts to become our base case here at the Bitcoin layer. Now that we're processing the FOMC meeting, of course, we have to wait till Powell speaks a little bit later and clarifies what they meant by that one sentence. But this is what we've been saying for the last few months. Okay, the general approach here is that inflation is bad right now, but it's slowing, and it's slowing forward on a forward basis, and that it's going to come down to a more reasonable level. The Fed isn't going to have to do anything crazy like the 70s and go to 6, 7, 8, 10% Fed funds. That's not going to happen. It's outside of our really base case realm of possibilities. And that risk assets are going to be okay because they've adjusted to this higher discount rate pretty well, and the appetite for these sort of assets, it doesn't it's not really in jeopardy using some other metrics like volatility. So I've been talking about this for a few weeks now. Why is volatility so average? Why isn't it heightened with all that is going on? It's not heightened because investors are not trying to pay through the roof for protection. They don't think that this downside scenario is in the cards. If they were, they would be paying up a lot more for protection, driving the VIX up, which is a metric called, it's called the volatility index, and it is calculated by looking at the options premiums that people are paying, more specifically in this sort of scenario, for put options for hedges on their long positions in stocks. And the bottom line is, with VIX trading in the 20s, every time it gets to the 30s, it gets sold down. It means that investors aren't that scared. They're scared then at periods than they have been in the last decade, when VIX would trade in the teens to the low teens even for months on end, when there's literally no fear in the market. There is some fear, but there's not a lot of fear. And that dynamic of there not being a lot of fear has been in the market for months. And that is a huge signal to us that we've taken away. And it does give us confidence to put out the thesis that risk is not falling out of bed. That's basically what we've been saying. And that we've also been saying yields aren't going to 5% and beyond. I know I said they weren't going to 4% about a year ago, but the inflation path that has been there has warranted this type of selling in fixed income. But there will be appetite, and there will be appetite at these levels, especially as the Fed goes to some of this language. And looking at the markets, not a whole lot has changed since we really struck all those levels. A modest rally in treasury prices, a modest rally in stock prices, and that's about it. So I really do want to get some questions up here. Anybody, that wants to come up, we'd be happy to hear your questions. Joe, anything else that you're watching here in the markets? 50 basis points for December seems like what they're trying to signal.
Absolutely.
The market should adjust there. And we have somebody here to ask a question. So why don't we let them in?
Hello? Yeah. I was wondering what the possibility is of a soft landing now. They kind of were predicting that. And do you think it's possible?
Yeah, it is a really good question. The soft landing versus the hard landing. It is semantic. Yes, the soft landing is possible if what we're talking about is a contraction in the US economy, either a contraction down to zero growth, or a mild recession, or even a modestly mild recession. If you include those in the possibilities of what it means to have a soft landing, then yes, it's very possible for the Fed to have a mild recession here, for inflation to come down, and for demand destruction to not fall to a point where we enter deflation.
So like a stagflation environment for multiple years in which...
Well, and it could be stagflation, but honestly, I don't think we're going to go to 2% growth and 8% inflation. So I think that gap will be a lot closer to the point where, pundits will argue about whether or not to call it stagflation. So our base case is that inflation comes down. There's a lot that suggests that inflation is not coming back down to 2% in the next several years. But we also think that inflation staying, above 5% is not as likely over the next few years. So if growth is, modest recession, then we go back to modest growth, and inflation is at about 4%. If you call 2% growth and 4% inflation stagflation, then sure. But, I wouldn't necessarily characterize it as that. And if you include a mild recession, growth coming back down, inflation coming back down, without, again, any real deflationary scare, if you call that a soft landing, then my answer to you would be yes. But it is, it is semantics there. Thank you for your question. Did you have any follow-ups there?
Not really. I mean, yeah. I mean, the other aspect is productivity. I could see inflation being present with higher prices, but lower productivity due to just the accounting, the currency of accounting.
Sure. And Source, why don't you go ahead with your question? Welcome.
Hey there. So basically, I think the statement there was kind of priced into the market, right? Like, as we're approaching the terminal rate, obviously the incremental change in what the Fed's going to hike is going to slow down. And I think the reaction that the market's giving now is limp. And I guess my question is, do you think that this sort of, as much as it's priced in, do you think this hint of the slowdown in the rate hike will be enough to sort of trigger a regime shift in risk, particularly where like the Dow Jones is sitting right now, kind of pressing its year-long downtrend?
Yeah, regime shift? No, this is not enough for a regime shift. This sets up the regime shift over the coming months. So remember, and you are right in that this is where the market was priced. That's why we don't have any, you had some volatility in the moments after, but really markets were priced here. We're at about 4.5% twos and about 4% tens. Again, stocks are a tiny bit higher, but not by much. So the market had this priced. The market was not sure if they were going to be a little bit more hawkish than this, but this is definitely leaning to the dovish side. But to answer your question, we don't believe that this sets up the true regime shift in risk. That comes later with the Fed getting more dovish, way more dovish, right? They just said sufficiently restrictive in a hawkish way. So until they use it in a dovish way, in that we've been sufficiently restrictive for too long now, right? That would be more the regime shift. So we're not at the regime shift, and that's why you don't see markets freaking out to either side. So yes, the markets were priced in right here, and no, we're not. It wasn't really a regime shift. Lee, go ahead with your question. Thank you for joining us. We're here at the Bitcoin Layer covering the FOMC November meeting live.
Hey, Nik, Joe, hope you're good. It's a little bit on point and it's a little bit off point, so excuse me. I'm just wondering what your thoughts are going forward with whatever it is that we're dealing with. We've got the G20 summit in Bali on the 15th of November, and obviously there's a bit of controversy about whether Putin is going to be there. Do you guys have any thoughts or ideas as to if that could throw a spanner in the works or kibosh for the Fed plans? And if so, what do you think would be the spanner? Thank you for your time.
Yeah, well, we already see that the UN's talking about the Fed, please stop raising rates. We think you've gone far enough. So we know that G20 politicians are going to err to the side of dovishness. They don't want to see their economies falter and employment pictures falter. The Fed has acknowledged that it's willing to risk this at the margin. So politicians are naturally going to be on the other side. I don't know that it does anything by itself to change it. Obviously, we'll watch the markets, the price is truth, and what comes out of there might influence markets. We won't ignore it if it does, but the G20 in terms of a source for volatility is not something that's in our base case. We will be also be watching the energy markets and any policy decisions that come out of G20 on energy policy globally speaking, because that will, of course, impact economies and supply chains and all that going forward. Who else? We have Craig. Go ahead, Craig, with your question. Thank you for joining us.
Hey guys, what effects do you think this will have for Bitcoin coming here in the next say 6 to 12 months?
Yeah, again, it goes back to the regime shift question. So pretty much it's the same answer there. It does protect the downside, I think, at the margin, but it's not a regime shift to the bullish times. The Fed is still pretty hawkish, even though they've introduced some dovish language. Now, we think Bitcoin has deep value because of where it trades relative to its realized price, 200-week moving average, and electricity input costs based off of the current hash rate. So from those perspectives, and people can go check out our publication, thebitcoinlayer.substack.com, which you see right pinned at the top of this Spaces. Go subscribe there. This is where we cover Bitcoin valuation, and Bitcoin valuation in the context of what's going on in global macro. So we cover all of it. We cover Bitcoin zoomed way in to the pure valuations, and then we cover it zoomed out looking at global macro. So thank you for your question.
So to build off of that a little bit, to expand, you're exactly right, Nick. As of right now, there's really no impetus to the upside for Bitcoin. This isn't a regime shift. This is when we use the word pivot, that sometimes might get conflated with regime shift. What we're talking about here is a pivot in the unbelievably hawkish tone of Fed speakers, where there has been no hint in an official Fed meeting of any change in the future. And now we are getting to the point where there are hints at a change coming in the future as a function of them thinking about the effects that their monetary policy has. And so it's ultimately, this is a marginal pivot in Fed speak alone, in the way that markets are reacting and in pricing the future path for monetary policy, right? So increasingly as we get there, it's not supportive of risk assets necessarily to the upside. Obviously, these discount rate for companies, and also companies that are high in interest rate risk like Bitcoin. There really is no impetus for upside. But that said, with something like Bitcoin, there's also you're hedged to the downside to a pretty large degree, and the reason that we say that is because Bitcoin is held up unbelievably well at this level. And I'll provide you an analogy really quickly. If you're in a drought, right? You're in a drought. Let's say you have two swimming pools. One's 400 gallons. The other one is 40,000 gallons. It's going to be much easier to keep the 400-gallon swimming pool full during the drought than it is to keep the 40,000-gallon swimming pool full. And as of right now, Bitcoin is that 400-gallon swimming pool. We've seen tremendous behavioral support in Bitcoin, despite the NASDAQ continuing to make new lows, obviously, despite this bear market rally. So despite Bitcoin being the highest interest rate risk asset of them all, right? So it's unbelievably sensitive to these continued moves upward and upward in the policy rate, which influences other rates up with it. Bitcoin is still defended at this level. $20,000 is an unbelievably, the back up the truck value buy zone in the eyes of the people who actually move these markets. And so as of right now, Bitcoin, at this stage is defended ceteris paribus. At this point, with this shift in tone from Fed speakers, there isn't necessarily an impetus for further downside, because the Fed speakers are acknowledging there's pass-through effect on monetary policies, that there's a lag, and so the market interprets that as a light at the end of the tunnel, a pause coming at some point Q1 or Q2 of next year. But again, that said, still increasingly high interest rates, QT, still occurring, no impetus for the upside either. So, Bitcoin being range bound would be a safe bet to go with here.
Yeah, and notice that we're not talking about QE, QT. Right now, the Fed is rolling down their balance sheet in a steady QT. What effects that's having on the market, we'll see over the coming weeks and months. But there's no QE, there's no rate cuts, there's really no drama here. There's just a one sentence of dovish language that people were expecting on something like this. So the Fed is trying to engineer a soft landing. Whether they'll be able to do it, it's for the economy to tell.
And
right?
That's what we're talking about, right? It's not that this is necessarily supportive. That's not why risk is rallying. It's because markets hate uncertainty, and when they get what they were expecting, they do well, right? Even if that means the thing in and of itself won't be supportive of the underlying asset. It's what markets were expecting.
Yeah, let's go, Phil, with your question. Phil, what's up, dude? And then the avatar with the cool pink hat. You can go next. So Phil, go ahead.
Hey, what's up, guys? Enjoy the space. So, as much as I would love to see the Fed do another 75 bips in December, if not my Christmas present of 100, that'd be amazing. I'm starting to warm up to the idea of Powell, and this has been kind of rumored, but maybe doing like a 50 instead, so he can, give his shareholders and friends on Wall Street kind of a breath, and that way they could let the Q4 closing around the holidays rally even more than expected. So, and with every time the markets do well, that also gives the Fed more room to raise rates even more, because they kind of use the latest rhetoric as an excuse to do so. So, what are you thinking about that?
Yeah, these guys really operate in cycles. So when they're at 70, 70, 75, 75, 75, 75, then they go to 50. The next move is going to likely be 25. And so they phase out the cycle. So it is likely to us that once they phase this cycle out, that it's phased out and that they'll eventually have to lower rates. But we're not going to make any projection on that. That's, I think, too far out, and it's too dependent on what's going on with the economy after this current weakness that we're in. So the bottom line is they're recognizing that economic weakness is present. They've tightened a lot, and that they're coming to a pause. So I don't really think that they're going for a stop, restart sort of approach. Just judging on the way that these guys have operated, it usually does happen in cycles. So let's go to the next question.
Hey, yeah, I just had some commentary. I think the market is expecting 50, 25, 25, then that tightening cycle is phased out.
Yep.
And you're saying there's no shift yet, but I think, they're not going to wait for the 50, the 25 and the 25. I think they might just want to wait for the 50 to make sure they're on plan. And then once they see that, like you were saying, the light at the end of the tunnel, then it's game on. So,
right.
And even though it is already expected, it could be game on now, they just want to see that first step. So let's see the 50, then they'll be confident that they'll do the 25 and then end it with the 25 in March.
Right.
So I think next month, if they stay on course and do the 50, then I think you could see that shift. I did disagree with being hedged in Bitcoin to the downside. If all markets crash, whatever, Bitcoin is going to crash harder. When liquidity is being drained, it's like a 400 gallon pool compared to a 400,000 gallon pool. It's easier to drain a 400 gallon pool than to drain a 400,000 gallon pool. So when liquidity is being drained, when we're going down, stuff is being drained. Now it is easier to fill it up, but that's when stuff's going up. So when stuff's going down, the smaller the pool is, the easier one to drain. So anyone thinking Bitcoin's hedged compared to the market, no.
It's a very fair point, and I would say that what we're describing here is along with risk, right? That we think that the risk position is
Bitcoin's a high risk.
Right.
You're going to get
And
better
we're talking
upside.
ceteris paribus, right? So there's obviously an increasingly, there's an increasing risk of a deflationary impulse like you saw in, at Lehman in 2020 during March. But by the same token, that's what it is. It's a risk. And of course that increases as fragility in markets proliferates, as we stay very, very high in rates and
Yeah,
liquidity
you
gets
could
sucked
say
out
like
as
risk adjusted,
so
it's a
as
good
liquidity
value.
gets sucked out at a very aggressive rate. But by the same token, we're talking ceteris paribus. Obviously, in that situation, Bitcoin would be drawn down with anything else too. What we're saying is in the current environment where, the Fed is making sure to project several months in advance everything that they're doing, should we not see any unforeseen huge deflationary impulse that sends all asset prices through the floor? That's what we're getting at here, right? There's behavioral support at the $20,000 level, ceteris paribus.
Yeah,
no,
and
it's a good value buy here. I'm in agreement. I'm actually bullish. I think the Fed will do 50, and I think once the markets just get that first signal that they're going to do 50, finish with 25, then finish everything with 25 in March, I think everything takes off, in my opinion.
Thank you so much for your take. Really, thank you for your questions, everybody. Joe, why don't you start bringing up the speakers? And I'm listening in. I think we have William next.
All right, William, let's hear it.
Hey, take up. Thanks for doing this. I appreciate
you're good
you
to go.
spending the time. Cool. Hey, yeah, I don't know if you heard that last part, but yeah, thank you. Anyway, my question is kind of related to Phil's. So I've just been looking at oil, and it's stubborn, like very persistent. Every time we get the hint of the bear rally, it's roiling back up. And looking forward, if we're expecting a marginal kind of shift in Fed speak, and we eventually maybe get some kind of sustained rally, I expect oil to rally right there with that. So you're saying that they have no flexibility, they go cyclical, but what, in the case where we get that sustained rally, oil is most likely rallying with everything else. That's, going to lead to inflation down the line, right? Input to everything. So what brings oil down to a level that makes the Fed comfortable with pausing, in the case of that sustained rally?
William, I got to answer your question with just being as honest as I can. Oil and oil prices are one of the inputs that, as a rates guy myself, I find it impossible to really build a whole thesis around it because I'm not an energy expert. Energy is highly geopolitical in nature. Demand and the economy does drive oil, but only at the margin. Like you're saying, if everything is going okay, it doesn't mean that oil prices are just going to go up with everything one to one. It doesn't mean that. So, I don't have a great answer for you because I'm not an energy expert. And I'll be the first one to admit that, we're watching the global economy as a signal on where rates are going and where inflation is going. Energy is one input. We try to incorporate what's going on in energy, but forecasting it and even, being an expert on energy and oil prices, just something that it's way beyond our area of expertise. I, would even welcome people to plug their favorite energy analysts and, what they think impacts, their models and all that kind of stuff. But it's just something that, as a rates person, I have to be watching things other than all the geopolitics that are going on around the oil market. So I'm sorry I don't have a better answer for you there.
That's all good. It's an idiosyncratic thing. It's its own beast. That makes sense.
Fantastic. So anyone up on stage, anybody in the audience, feel free to raise your hand or hop off mute if you have any further questions. But for the folks in the audience as well, I've gone ahead and plugged our Substack up at the top. If you like what you're hearing and you want more Bitcoin through a global macro lens, you can go up to the top, hit subscribe there. It's a free option. We also have paid options to get all of our research, but every single week we offer you a top-down comprehensive view on rates, money markets, commodities, and how it all fits into Bitcoin.
Joe, hit us with some headlines from the press conference. I see some things coming across from Powell. What do you see read on the Bloomberg terminal?
Of course. So the first thing that I'm seeing here is that Powell says Fed still has some ways to go, which of course, is the typical Powell. Generally speaking, this is exactly what we've seen over the last few meetings as well. The minutes themselves lean dovish in their language, and then Powell comes out and is slightly more hawkish, right? This is sort of the expectation. Another line from Powell: the ultimate rate level is higher than previously expected. So Powell is essentially portending here that terminal might be higher than what markets are pricing in now, if I'm interpreting that correctly. Those are a few things that I'm seeing across the top of my terminal. If you wanna react there while I pull up some more.
Yeah, and why don't you just reset markets for us? What is December OIS trading at? Twos, tens, anything going on the curve, on the Treasury curve here, and give us a risk overview and dollar as well.
Absolutely, yeah. So in response, we've seen December OIS move back up. It's actually sticky or staying at the 50 basis point level. Generally unchanged. I mentioned a little bit earlier in the call that terminal had moved below 5. It's now right at 5 on the money, so 5%. So ultimately, it seems Powell is pretty much in confluence with what the minutes were saying. As he started speaking, taking a look at some of the rates moves, tens are giving up a little bit of their rally here. Twos are giving up a little bit of their rally. They're moving a little bit slightly higher on Powell talking. Same thing with equities. On the news themselves, when the actual Fed minutes dropped, equities rallied pretty sharply. We mentioned that. As of right now, they're chopping around, of course, because exactly like Nick said, insider baseball. There are algorithms that are out there that are trading Powell's language, right? So that's how granular, that's how to the T markets are right now. They're so specific to the point that there's extreme chop when Powell, throughout Powell's speech right now. Moving over to Bitcoin, similarly choppy. 10-year reals similarly choppy. The dollar, it actually rallied quite sharply, or excuse me, it fell quite sharply in response to the Fed meeting minutes. Obviously, forecasting the path of hikes is eventually going to come to an end, implies a weak dollar at some point in the future, and then the dollar gets sold relative to the other basket. But as of right now, it rebounded slightly and is chopping around there. Taking a look at the curve. Taking a look at some of these treasury curves here. Obviously, earlier this week, we saw the 3-month 10-year yield curve invert very, very materially. So essentially, this is one of the yield spreads that inverts historically close to a recession. So the 3-month yield is higher than the 10-year yield. And off of the Fed meeting minutes, it is inverted much further. There has been a pretty precipitous bid. So people are buying the 10-year note, and what that's doing is it's driving the 10-year yield down relative to the 3-month yield, which is getting much less buying power. Now, layman's terms, the reason why this is, there's something called interest rate risk, right? The further out you go on the curve, the more interest rate risk you incur. When people anticipate that rates will be coming down, they tend to bid up the long end of the curve first, which sends yields on the long end down. And so as we are nearing sort of that shift in the cycle where rate expectations are beginning to level off and eventually start falling, today being the perfect example, then you start to see the 10-year yield start to move down pretty materially, and that's what we're seeing right now. Frankly, I put out a tweet a little bit ago saying, 2-3 weeks ago, putting out this chart saying that when the bid for duration comes, it's going to come hard and fast. And as of right now, we can see, the bid for duration really entering the market, and that curve is pretty steeply inverted. Along with it too is the 2s 10s curve. This is the one that people are more familiar with. It is also moving down. It's actually steepening slightly. It's moving up. The 3-month 10-year curve is really deeply inverting here, and it's inverting even more as Powell talks, as he's speaking. Taking a look at the dollar relative to everything else, it's marginally lower on the day. I mentioned the intraday move, but taking a look at the dollar itself, it is essentially flat, if not slightly low. And this is good for essentially every other dollar pair. I'm looking at the Great British Pound, the Euro, the Yen. All of these are really appreciating the fact that even in the future, markets now know that the Fed is aware that its monetary policy works on a lag. It's aware that essentially what the Fed speak is pointing to is that at some point eventually there will be a pivot in interest rates. There will be a shift downward in the pace of interest rate rises, which will be naturally supportive of interest rates. Or rather, other currencies that have central banks that are not as tight as the United States Federal Reserve. And that's naturally good for their currencies, right? Basically, every central bank has had to play catch up to the Fed with the speed at which the Fed's tightening. And for other currencies, essentially in times like these, the dollar is getting bid up tremendously because of interest rate differentials, because rates in the United States, not only with U.S. Treasuries, but the Federal Reserve policy rate are higher than can be found elsewhere. And so you saw that natural bid emerge for the dollar. And now as the end is near for these rate hikes, once again, you're seeing the dollar start to lose some of its steam. So
And I want to go back
that's
to
essentially
real
what I'm
quick.
taking a look at here.
Yeah, real quick. I want to go back to what one of the audience members asked, which is this a regime shift? And I think that's the main takeaway, and that I have here is that Powell is setting up the regime shift, but this is not the regime shift. So the next few weeks will be more Fed speak. How much more do they have left? But they basically opened the door to the doves today. It is what we were expecting. And we'll be covering everything at the Bitcoin layer. So thank you all for joining us today. This has been a lot of fun. I don't want to beat a dead horse on markets that really aren't chopping around that much, as the Fed has kind of introduced its dovish language and now wants to see how the market processes it. So find us at thebitcoinlayer.com, first of all, for everything that we do. We have our Substack publication, which you should go subscribe to, thebitcoinlayer.substack.com. We put out 3 pieces a week on global macro and Bitcoin, talking about Bitcoin specific stuff, Bitcoin in the context of global macro, and sometimes just pure global macro. We have a YouTube channel. We're putting out videos a couple times a week there, including we've started to do interviews, guest lectures with global macro and Bitcoin and geopolitical experts. So go subscribe to us on YouTube. We're also on every social media platform at the Bitcoin Layer. So go follow us there. And thank you so much for joining us today. Joe, I'll let you wrap it up.
Fantastic. Thanks again, Nick. And thanks everybody who was in attendance. I'll leave you all with one more quote from Powell. He says, the time to slow rate hikes may come as soon as next meeting. So there you have it, very explicitly. Ultimately, what this meeting was about was portending a shift will come in the future, but this was not the regime shift. This was simply the Fed acknowledging that there will be one down the road. It's what the market was expecting. So, continued expectation of choppy markets, but for the first time, we're seeing a hint at the potential light at the end of the tunnel, but this isn't the full shift as of yet. Thanks once again for joining us for these FOMC meetings. We do these every time there is an FOMC meeting. So follow us at the Bitcoin Layer on Twitter. Just click that profile that you see speaking right now, hit follow, hit the link up in the nest, thebitcoinlayer.substack.com. Subscribe to the Substack newsletter. It's free if you want to get the best in Bitcoin and macro to your subscription inbox, to your email inbox 3 times weekly. That's what we're all about. We are a Bitcoin and macro research publication. We want to keep you up to date with markets. This is an elevated time of uncertainty. So at the end of the day, if you're looking for guidance, we're the people to follow.